Michael Saylor has just said that the NAV premium on strategy isn't the story. Traders might obsess over whether the stock trades at a premium of 1.5 or a 2x, but he argues that misses the point. Over the past 2 months, both Bitcoin and strategy have come under significant pressure. Bitcoin slipped below $109,000, and strategy stock fell even harder, dropping below $300 after reaching $450 in July. That slide dragged its premium to net asset value sharply lower. Earlier this year it was around 2, but this month it fell as low as 1.35, the weakest level we've seen all year. For many investors, that looks like a red flag. Sentiment around Bitcoin treasuries has already been shaken. Is this just more capitulation? Is the market losing faith? Saylor's perspective is different. He points out that while sentiment and multiples swing, the business itself has only grown. More Bitcoin, more credit products, more scale. The real story isn't where the multiple sits today. The real story is what strategy is building on top of its Bitcoin, a new asset class of Bitcoin-backed credit. And when you step back, the scale of that vision is enormous. Global wealth today is about $1,000 trillion, with $370 trillion in real estate, $320 trillion in bonds, $260 trillion across money markets and equities, $25 trillion in gold, and Bitcoin, just over $2 trillion. If Bitcoin-backed credit really is the killer app, then strategy isn't just trading on a NAV multiple. They're positioning to tap into capital markets hundreds of times bigger than Bitcoin itself. That's why Saylor says the premium isn't the story. The driver is something much bigger and maybe the most important financial innovation of this decade. Like, subscribe and let's get into it. What we've just seen, the premium sliding from 2 down to 1.5 and even hitting 1.35 at the lows, isn't a flaw in the model. It's the market cycling through risk appetite. Back in the euphoric run last November, that premium peaked near 4. Last week's dip to 1.35 was the lowest level we've seen since then. And here's the key, the business has actually grown in that time. Strategy holds more Bitcoin today, they've launched more credit products, and their operating scale is bigger. The multiple, on the other hand, is just sentiment moving up and down with the market, not the fundamentals. For 300 years, finance revolved around gold-backed credit. In the 20th century, we had bank credit, mortgage credit, sovereign credit. Now, Saylor says the 21st century belongs to Bitcoin-backed digital credit. Strategy has already launched products like Stretch, Stride, and Strife, and they've rolled out 4 multi-billion-dollar instruments this year alone. That's what makes the equity unique. Not just exposure to Bitcoin, but the ability to build entirely new credit markets on top of it. It's important to understand where the yield actually comes from. Of course, Bitcoin itself doesn't generate a dividend. The yield is engineered through financial products, strategy issues against its holdings. Some investors buy in for predictable income, others for leveraged exposure to Bitcoin's upside, and these instruments are structured to serve both. But here's the truth. The sustainability of those payouts ultimately relies on Bitcoin appreciating over time. In a weak year, where Bitcoin is flat or up less than the promised yield, the model can feel pressure. Thanks to over-collateralization, strategy can weather that in the short run. Over the long run, while they have different strategies they can deploy, the engine is designed to thrive if Bitcoin outperforms. That's why this isn't a short-term trade. It's a play for long-term believers in Bitcoin. And that ties into the never sell philosophy. It isn't just a slogan, it's embedded in the way their balance sheet is built. With around $73 billion in Bitcoin against only $6 billion of instruments, they're massively over-collateralized. Dividends require just a minimal amount of equity issuance to cover, and new credit products give them additional liquidity without touching the core stack. That said, Saylor did admit at the recent unconference that in an absolute last resort scenario, if survival truly depended on it, they would sell. It's not the plan, but it's the safety valve. For now, the structure means they can keep compounding Bitcoin without being forced into desperate sales. Saylor makes a sharp distinction between stablecoins and Bitcoin. Stablecoins are the currency of crypto rails, whilst Bitcoin is digital capital, and that's the cornerstone of Strategy's model. They're not trying to make Bitcoin a payment network. They're using it as pristine collateral, the bedrock for an entirely new generation of credit markets. And finally, the roadmap. This is where Saylor goes from ambitious to outright transformative. Strategy isn't stopping with dollar products. The plan is to launch stretch-type instruments in euros, yen, pounds, even Canadian dollars. Think about what that means, a Bitcoin-backed savings product that could plug into financial systems across the world. Saylor's argument is simple but powerful. Everyone wants a safe place to park cash that pays real yield. Traditional banks can't provide it. Central banks can't print it. But with enough Bitcoin as collateral, you can engineer it. If they pull this off, Strategy stops being just the world's biggest corporate Bitcoin holder. They become something far larger, a global issuer of Bitcoin-backed credit, building the high-yield bank account of the future, one currency at a time. And remember, this isn't just about a premium or a multiple. Global wealth sits at 1,000 trillion, and Bitcoin is just over 2 trillion of that. If even a fraction of those bond or money market pools start to flow into Bitcoin-backed credit, the upside isn't incremental, it's transformational. So here's the takeaway. Traders can argue all day about whether Strategy trades at premium of 1.5 or 2. But Saylor's message is clear. The premium isn't the story. The story is Bitcoin-backed credit, a brand new asset class being built on top of digital capital. The open question is whether the market eventually rewards that vision, or whether Strategy is simply too far ahead of its time. What do you think? Is Saylor right that the premium doesn't matter, or is the compression a warning sign? Drop your thoughts in the comments, hit the like if you found this breakdown useful, and subscribe for more.